In today's world, typically what is happening is it's a changing market condition and the market dynamics are so fast and quick, and cross-border and cross-geographical impacts are so huge that a CIO has to rather preempt and keep himself updated on actions to be taken, actionables in different scenarios of attack. If the market moves by X percentage, how much, which part of my portfolio will get affected, how much, and what should I do to manage this sort of a liquidity problem or a concentration risk, various aspects of risk that I'm facing. Second thing that a CIO has to also manage is the reputation risk and compliance to various internal as well as regulatory norms. This also somewhere begins to work into the work area of Chief Risk Officer. So to some extent, a CIO and a CRO have to work hands in hands to see that ultimately the risks are mitigated, to a large extent preempted and managed. When you talk of risk management, I always appreciate the ICAP advanced approach, internal capital adequacy assessment process, the advanced approach, where you even talk of a step beyond Basel II, Basel III. Some of the components definitely can be implemented right away by the various credit risk chief risk officers. Like for instance, put in a robust framework first of all, then you have a proper governance structure. What is important here is the minute you put the onus of a governance structure at the board level and board periodically reviews what you're doing, there is a complete buy-in from the top management for a top-down risk approach. Traditionally, risk has been managed bottom-up, as in when you see a check, you do verify the signatures. When you get money, you check whether the user ID is right. These are all minuscule operations which you try to tie down at risk management. The bigger issue is risk management should also be a top-down approach. The only successful risk officer is one who is able to tie down a bottom-up and a top-down approach. One of the most proactive approaches to risk management as well as investment management is to have models, scenarios worked out and analyzed before you initiate an action. Simple things like if I have a portfolio which has various credit limits and credit risk exposures, if I were to have a downgrade of some of these, or if there is a duty change in some sector, how will it impact which stocks or which portfolio components and by how much? So this scenario analysis, if a CIO has before he makes if a model is readily there available, if an analysis is already available, then even a reactive action can be very fast. So one is to have the scenario and do it periodically and review it. Typically what happens in Aditya Birla Mutual Fund, so to say, is we have various committees called the investment committee, we have a risk review committee, we have other oversight committees like the audit committee, etc. But typically in the investment committee where the investment CIOs and CEOs sit together with the risk officers, what we try and do is the scoring of various portfolios. We have models to score the extent of credit risk that is there. So if I feel there are certain vulnerable securities, I will downgrade those securities and revalue my portfolio and see the mark-to-market component loss in my portfolio. It might not be an actual loss, so I do it. The other thing that we also have is a liquidity portfolio scoring. If my portfolio has to be liquidated, how much of my portfolio can be liquidated within 1 day? How much of my portfolio can be liquidated within 3 days, 5 days? And we have these standardized models put across various components. Like I have a mutual fund, I have an insurance, I have various other arms, right? So we have, with a minor tweaking, we have similar models and standardized models put across all our units. So even at a group level, we will know. So it gives me an insight that if there is a sudden redemption pressure, how do I handle it? If there is an advance tax outflow coupled with some regulatory injunction which brings in mark-to-market component of even lower tenor securities. How do I manage this? So if you know that you have to go on a mark-to-market, for recent regulation of SEBI says that mark-to-market component of some part of your portfolio which was above 90 days has to be mark-to-market on a daily basis. So now if this comes, obviously because I'm having securities which are slightly of a longer tenor, I'm going to have an impact. So how do I manage this? This I know is going to happen sometime in July. So sometime in March, April or May, when the regulation came in, I will start working towards how this will impact my portfolio and how I need to move towards this in a, what a graded manner I have to move. IT is a big enabler. IT is an enabler because it, at one go, you can see across your units what you're doing. You can also observe how the impact will be to a particular portfolio at a unit level, at a group level. So IT is an enabler essentially.